Thank you very much, and good afternoon, everybody, or good evening in some places. I'm very pleased to be running this panel. I think it's a very interesting, very timely subject. I've worked in the energy space for more than 30 years now in finance, and I've seen many changes during that period of time, but probably this is one of the more fundamental changes, or one of the more interesting crossroads that we're at now, where we see a very significant change now being faced by players in the energy market, and a significant degree of uncertainty going forward. And I think as an entree to this particular transition, we've seen what's happened in the power sector in the past. I mean, I started my career working on coal-fired power stations in the US and Asia, and I'm now busy on offshore wind, like many of the panelists, globally, so in Asia as well as Europe and the US, but also now looking at some of the more interesting new transition technologies. So it's a trend that's spreading around the world, and I think when you look at the annual reports of many of the energy companies now, we've seen a significant increase in the number of pages devoted to ESG issues, decarbonisation, changes of strategy. And culminating recently in the announcement from BP around their net zero target. And net zero is becoming an increasing trend of both corporates and governments, both at national level and regional level in the EU. So it's worth considering during this panel how we deliver that net zero, or how we finance that net zero. But that takes me on to the panel. We've got a very strong panel today, in my view. It assembles people who've got expertise in a range of different sectors, a range of different products, everything from equity through to debt, everything from oil and gas through to the power space. So hopefully it'll be an interesting discussion and a good Q&A. So feel free to ask questions of the panel as we go through. So first up, I'd like to introduce Bert van der Toorn from ING. Bert's got a broad experience of working in the energy sector, and an interesting background in many senses for this, given that he started his career at Shell, worked also at EBRD before going into investment banking with ABN, now ING. Mr. Jing Liu, who's a sector lead for power utilities, metals and mining, so covering a lot of the sectors which are going to be impacted by the transition at SMBC. And again, Jing has been active in finance for more than 10 years, or 15 years, in fact, focusing on project finance, structured financing. So he's led a number of offshore wind financings, as well as running acquisition processes for various assets in Europe, and also working on IWPPs in the Middle East. So again, broad experience. Mr. Ting Deng, from Santander. I'm not sure whether Ting has joined so far, but hopefully he will join. So Ting leads Santander's M&A origination and execution effort in the renewable sector, which is becoming increasingly interesting. I think the days when you close the project, the sponsors stayed the same, and rolled on to the next project have disappeared. We see a lot more M&A activity in that sector now. And last but not least, Tarek Soliman from HSBC, who brings an equity perspective from the oil and gas side of the business, which is actually the critical space we're in now in the energy transition, I think. And he's worked for a number of years as an analyst in this sector, so brings a lot of experience into the discussions around ESG, climate change, and the energy transition. So I think during the session, what we like to try to achieve is to look what the future holds for oil and gas as it starts to transition through to a cleaner energy future. How finance plays into that, so the availability of debt and equity for both the industries transitioning, but some of the industries that it leaves behind in terms of maybe what could be called twilight industries. And then to touch on decarbonisation of the wider energy economy, which is absolutely essential to get to net zero. How do we get there? And that will lead us into a discussion around, hopefully, financing of new technology. So hydrogen and carbon capture and various other technologies that we see coming through now. So maybe to start, if I could hand over to Tarek, to maybe give a sort of overview on what he sees in terms of the impact of transition on the oil and gas sector.
Great, thanks, Allan, and hello, everyone. So yes, as Allan said, I work on the equity desk at HSBC. I look at oil and gas, but also adjacent to energy companies and sources, which are all becoming part of a very interesting intertwined story. But I'll talk about how the markets are interpreting the energy transition with a focus on public oil and gas companies. And climate, the energy transition, these themes are really pushed to the head of the agenda in the last 2 to 3 years, and in terms of shaping how markets think about the future of energy. I'll mostly focus on an EU, US sort of side of the story, but happy to talk about emerging markets in the Q&A. It's just that in Europe and the US, obviously, it's where things are moving most quickly at the moment. But there's no real surprise or no secret that there's a strong preference at the moment in equity markets for pure green stories. There's a willingness to invest in new technologies of the future: wind, solar, hydrogen, electric vehicles, etc. One company I spoke to recently described it as green fever. But this acceleration in that type of view has been coupled with a really tough time for oil and gas, and it's fallen out of favor in markets. And that's not only linked to the weak fundamentals in oil markets, which we all know are where they are, but it's also around the role of climate and the energy transition. We see, particularly in Europe, investor portfolio constraints as to which types of companies they can hold and what types of exposure they can have. But the idea of an energy transition also poses more longer term and sort of conceptual questions about what the future of these companies will really look like. But one view that we do hold is that big oil will have a really important role to play in this transition. And I'll give some reasons why that in a moment. But just Allan talked about net zero. It's a big buzzword at the moment, but I just looked at some statistics yesterday, and of the countries that have announced plans to go to net zero either in 2050, 2060, places like China, the European Union, the UK, more recently Japan and Korea, that's about a third of global oil demand and about a quarter of global natural gas demand in jurisdictions that have said they will wipe out emissions within 30 or 40 years. If the US election shifts in favor of Biden, and I'm not speculating, but he made a net zero pledge, that would take about 50% of global oil and gas in countries that have said they're going to go to net zero. So it poses a real question for large hydrocarbon producers, particularly those that are publicly held, around long-term plans. An investor in Europe could quite feasibly say, what does oil and gas look like in a net zero region? Certainly doesn't look like what it does today. So as a result, a lot of the big producers, especially those in major indices that have diverse shareholder bases, are facing a race to stay investable. The good news is big oil can bring a lot to the table in this energy transition: scale, customer relationships, project management, technological know-how, access to capital, trading and distribution. There's a whole load. So in response, at least a lot of the larger companies, and again, I'm focusing here on the Europeans, it applies a bit less so to emerging markets and US companies, but we have looked at those. But the Europeans have responded with plans to reinvent themselves. And we've modeled these out and what a Shell or a BP might look like in 20, 30 years. And it entails big cuts to hydrocarbon production, but large build-outs in renewable energy businesses and other low-carbon technologies. And we're already starting to see that process happen, where we see CapEx budgets, 20% or so, going into these new businesses. And that translates to billions of US dollars a year. A lot of the IOCs are going down an organic route, but there's still plenty of scope for small and large-scale M&A. Although some of the green companies are getting a bit expensive for them to buy at the moment. But the shift of capital is large and it's happening. I'll just wrap things up by just talk about what this means for markets, because the issue that this poses, and again, Allan touched on this, is uncertainty. The shape and the pace of the transition is unknown. Markets don't like the perceived lack of clarity around financial returns for oil companies, in particular, transitioning into new businesses. There's an absence of a track record. Oil stocks have also traditionally been very healthy dividend payers. And that's something that some European producers have had to sacrifice this year to not only get through COVID, but fund a transition. So strategically, there's a lot of competing demands on oil and gas companies, which are difficult to all please at once. One data point that we've looked at to get just a sense of market appetite for some of these strategies, we looked at the gradual approach of Total of France versus the much more drastic approach of BP in terms of their respective transition plans. If you plotted them on a graph, you'd find Total share prices outperformed that of BP by 50% this year, 50, indicating that probably the markets want less change rather than more, or they're assigning a first mover disadvantage to BP. Either way, it's not a great signal for other producers trying to go down that route. So in summary, I'd say markets are grappling with a lot. There's big shifts in the macro pictures. There's technological advancements that are probably happening quicker than we would have thought of a few years ago. There's short-term pressures to keep investors happy. And there are these longer-term conceptual ideas about what an oil company or an energy company in the future looks like. And the issue is that we're having to grapple with all this against a much higher than usual volatile background of COVID. I'll just end on a quote because I picked it up on the FT recently. The former CEO of a utility company in the US, NRG, he gave his thoughts about the challenge of changing an energy company through the energy transition. And I quote, "One lesson I learned is that transforming a big energy company in the glare of public markets is almost impossible." I'll hand back to Allan on that note.
Thank you. I remember NRG's attempt to change last time. Very painful for us as well. Thanks for that, Tarek. Very interesting. Maybe handing over to Bart for maybe a bank view on transition and what it means from a debt perspective. Bert, sorry.
You might need to unmute.
Yeah. Good, thank you very much. Apologies for some delay here. The bank's perspective. What we've done recently, make it or break it scenario planning at ING, looking at the fossil fuel industry, so very much oil and gas as well. And we made some scenarios as a bank. As you can see, our forecast, which I would take the orange line as the most likely scenario, quite clearly indicates coal is going down, but not as much as people anticipate. Oil is still not going down, but it's reaching its peak. And gas most likely will increase. So if you look at it from a bank's perspective, yeah, this is of course not something that we have much influence on. It basically means that as a bank, we've decided not to be part of the coal transition. That's also for public under public pressure, I would argue. On oil, we're clearly looking at places where they're not going to be stranded. So oil developments we will still support, but only when it's not stranded, and it makes perfect sense. And of course, it fulfills all the environmental and sustainability requirements. And on gas, we are a bit more hopeful that that will continue to grow for the hopeful for the gas industry, because it is the least polluting fuel apart from, of course, renewables. And renewables themselves, we also foresee, which is not in this slide, to grow quite significantly, but it will still have difficulty meeting the immense energy supply needs of the world. So we still foresee this to continue, even if all the other initiatives are accelerating. So this is a little bit how we see the future of oil and gas. I think what you quite clearly see, there's a lot of pressure on, as Tarek already said, on IOCs to divert away, or at least partially go into renewables. But of course, the NOCs may have less incentive to do this, and they control most of the fossil fuel reserves. So in that respect, we do still expect these investments to continue, with or without equity or debt financing. Of course, it will slow down quite significantly if there's no financing, because then it has to be financed from cash flow. On gas, you can see we see this increase. So in that respect, there's quite some infrastructure already, and we see, of course, gas prices today, or actually a few months ago, hitting rock bottom. But that is slowly going up again, and if you look at the forward curves, that's still going up. So quite clearly, there will be an equilibrium that needs to be reached within those investments, and the banks will take care that they're not going to be affected if gas prices stay low for a long period. Now, other industries related to this, it's not my expertise, but of course we look a lot at mining and seeing what they are doing. I mean, it's a silly remark, but energy efficiency is still the best way to decarbonize, and we see that very much in these side industries. So what else do we as a bank do? Of course, we're very active in renewables, but also we're very much looking at the green or clean hydrogen and the blue hydrogen initiatives. We're very keen to support those. We just to step with the first one that's most like the oil and gas industry is, of course, blue hydrogen. There we foresee that the taxonomy will allow, the EU taxonomy, for instance, will allow this to be going forward, because it will reduce CO2 emissions significantly for existing hydrogen production. And also we do foresee, especially in places like the Middle East, that they can create sufficient production of clean hydrogen, which then will have to be, well, first locally used, but otherwise shipped by pipeline or by vessels to other markets. And given the abundance of solar and also wind in the region, that could be quite interesting. Yeah, so we're very much focused on seeing how that will develop and how we can be supportive of that. So basically, the oil and gas industry can help this transition quite a lot. They're very good at the process management, but also they control quite a lot of the infrastructure. So we also see a role for them there. But to get these new industries off the ground, just like solar and wind, regulatory support will be quite needed. And electricity prices have to go down, which is good with lots of solar. So to conclude my remarks, I really like the July Economist article, which made very clear that electricity will be taken care of mostly by renewables and solar and some kind of storage options. But the rest of the industry energy needs will need to be sourced from other places, and there hydrogen can play a very key role. So we as a bank are very much focused on how to support that, as long as there's a business case to be made. So that concludes my remarks.
Thanks very much, Bert. And we'll come back to hydrogen without doubt. It seems to be one of the volume businesses available. So maybe Jing, I don't know whether you had some comments as well, general comments from your perspective.
Yeah, certainly. I think from my side, for energy transition, I think I will probably start with some key challenges here and what opportunity presented to the weather sector as well as the banks. I think for key challenges would be clearly, in order to achieve energy transition, I think more progress needs to be made outside the power and transport sectors. I think we have seen significant progress being made in the power transport when we have more and more renewable projects being built up, especially in West Europe. But this sector only accounted for 50% of global emissions. So a lot more progress will be needed to be made in like refining, other heavy industries, at residential and commercial heating parts. I think that would be important to achieve the transition. I think the other side is that this decarbonization will require massive increase in electrification. In order to meet this Paris Agreement to manage the temperature within 2 Celsius degrees scenario, I see some research suggesting that power generation capacity needs to grow by over 20,000 gigawatts within the next 20 years, mainly through the PVs, wind, and the power storage side. I think there will be significant growth required on that front. I think the other part is that the supply chain, and for example, even just for the battery storage, which is critical to help renewable sector to address its intermittency issue. We know that for battery storage, the key components like lithium, nickel, cobalt, etc., all the key minerals. And there is a supply chain issue, like, for example, cobalt. 60 or 70% of cobalt reserve resources are coming from DR Congo. So if you want to shift it more to nickel side, you will still see a long development timeline required for all these mines, from pre-feasibility studies to feasibility studies until exploration. So even if you plan now, it will take 7 or 8 years before this mine coming to life, because all this will constrain how the battery storage and the supply chain that would to meet the requirements from renewable sector. And of course, we have also some short-term challenges in this part about the public finance or government financing available, especially currently when government trying to prioritize the financing and constrained by the budget given the pandemic. Although some government do try to balance the requirement to meet the long-term sustainable development and the short-term economic recovery by investing more into the green energy or transition part, which is quite critical, but we still see this public finance constraint may delay or slow down the investment in the sector. I think the opportunities presented is quite significant as well. As mentioned earlier, this will present opportunities for banks and other industries, literally across sectors, from the power renewables to oil and gas to infrastructure, transport, etc. Even just for within renewable side, we see, given the technology development, we see some new sector, new technologies which will require financing and support, like a floating offshore wind. We see some pilot scheme being built up in France, and like energy storage, which is quite critical to address the intermittency issue in renewable sector, and the hydrogen. I'm sure my peer group in the panel will discuss further. I think from bank side, there are significant opportunities during this transition as well, and this allows us to support the companies to transit. Actually, I think a bank already helped to contribute during this process by support the development of this whole ecosystem for the green economy, by providing various different products. Just from financing side, like you use project financing for the greenfield project. That's how the offshore wind in the UK being developed initially. Although nowadays, I think the liquidity pool has been widened, including some even project bond and institutional investors coming to the game as well. And also acquisition financing and various different risk management products from financial markets like FX, IRS, or retail price index to manage our inflation. I think all these products from banks are available to support our clients from both the renewable side and the oil and gas side who try to achieve this energy transition.
That's very interesting. Thanks, Jing. Ting, I don't know whether you can give a bit of flavor from the M&A side.
Yes, happy to. I think from the M&A perspective, I think we're anticipating this is just a very start of the energy transition. I think there's a number of aspects to sort of the energy transition that will sort of play in the M&A market over the next few decades. And I think the first is I think very much that the players utility players who are already operating in the renewable space are looking to sort of broaden their presence geographically and also increase their scale and capabilities. Historically, utilities tended to be a bit more regional and country focused, but now we're seeing a lot of especially European renewables developers looking really far afield and geographically to gain pipeline, try to leverage their expertise in building out and accelerating sort of the energy transition. So from a utilities point of view, I think that sort of story has already been playing for a few years, and the next few years will be very much about transitioning their own business model and broadening their reach and scale as well. I think from the point of view of the oil and gas majors, I think there's a sort of existential question, as Tarek and others talked about earlier. And I think some have been sort of rewarded for their bold statements and ambitions, and some have been probably less rewarded. But here, I think we're starting to see some initial moves, but we're anticipating that there will be some major sort of bigger moves and some more transformational moves in the years to come. I think some of the oil majors were looking to obviously get into the generation side, energy trading side, and I think some also into supply side as well. So I think there's a sort of a wait and see approach from some energy providers, but I think the fact that utilities who've made the transition early, such as Ørsted, have been very well sort of prepared and now rewarded by the market. I think there's now an incentive and also a little bit of a blueprint for some of the oil and gas majors to start making that transition. And due to the size of the major oil majors, I think we're likely to see some incremental moves in the short term before some large transformational moves, which I think they have to do down the line. I think the other sort of major interesting sort of I would say M&A trend is the role of asset rotation and capital recycling. I think renewables assets are, especially with subsidies, are obviously very attractive to financial investors and also investors looking to partner with developers and operators to learn about how to build and operate renewables assets. I think some of the players like Ørsted and RWE, Iberdrola, and Equinor have already been very successful in sort of in generating capital gains and also recycling capital very quickly after they sort of get into the sort of shovel stage of the development of some of their assets. I think that will be an increasing sort of trend, and we see infra fund and financial investors playing a bigger role as the utility, especially the utilities who have the pipeline, look to accelerate the rollout over the next few years.
Okay, thanks. Very interesting. Just maybe following up on one of your comments around how the oil and gas industry gets to scale and makes that transition. And I guess it's a question for a number of people on the panel, but if you look at where they are now and the scale of those businesses, I think they're in a different position than Ørsted were a few years ago, with a very rapidly growing offshore wind industry and largely on their own in terms of looking for opportunities. We seem to be in a slightly different place at the moment, with a lot of equity chasing a relatively small number of projects. I don't know whether you have a view on how quickly those companies can actually transition, whatever their targets are. Are there obvious routes for them to make that transition in a relatively rapid sense, or are they going to be constrained by opportunity?
Well, maybe I can take this first, Allan, and I'm happy to hear everybody else's views as well. I think You made sort of a good points there. I think there's sort of limited number of opportunities, and I think the oil and gas majors probably still lack some of the, I would say, capabilities to construct and develop versus an Ørsted or an SSE, who have obviously a great track record and sort of capable and stronger capabilities. What I would say is that right now, I think they are making some incremental sort of acquisitions, and I think some of the big issues that you have is the IRRs expected in some of the projects in the Western European countries is solidly now in the single digit, whereas a capital sort of IRR requirements for some of the oil gas majors still are solidly in the double digits, and sometimes even higher for riskier exploration projects. So I think that is something that we're very cognizant of, and I think the oil and gas majors, it will take them some time to get used to that. And I think we expect that they'll make incremental moves until there's a point and the pressure builds up, and I think in order to get the scale and accelerate the transition, they will have to make some more transformational moves. We've seen that in other industries like telecoms, internet, albeit blatantly for a lot of the retailers. So I think there are a lot of lessons in the transition of other industries. I think the oil and gas majors will need to learn from to not make their moves too late.
Is there room for everybody? That's the other question, I guess.
I think. Yeah, sorry. Well, I suppose I'll make one last comment before passing on to the others. I think we've done research, and it looks like the balance sheet of all of the utilities and oil majors, they cannot sort of fund all of the developments that all of the countries, even in Western Europe, have said that they wanted to target by 2030. So I think there is probably room for everybody and more, because there's a need for capital.
Okay, that's interesting. And Tarek, I don't really want to maybe comment on the point around the return expectations, because I think it was IEA who put it as a balancing act between short-term returns and long-term license to operate in many respects for these companies.
Yeah, there's very much a lot of that applies here, and it's not something that I think the markets have really got their head around, because big oil companies don't tend to disclose the information behind their clean energy businesses, which, if they were on a standalone basis, would probably be quite sizable. But because they're in a big organization, we don't get to see it that much. And there's also the idea of the invested capital in these companies is so heavily skewed towards the existing businesses that it will take a lot of time and a lot of change before any of that returns dilution becomes visible. That doesn't stop people worrying about it, but it'll take a while for it to start impacting at a corporate level. On the speed of change, I've just got a couple of quick things to say. One would be we've noticed big oil and gas operators wanting to get involved in the development of the projects rather than buying them in a little bit more recently, partly because I think I mentioned earlier that the price tag for going in and buying the ready-made thing in the form of another corporate has shot up in the last 2-3 years. But it's also part of their strategy to try and lift those returns closer to double digits, which BP says it can do by getting in early, project financing, risk sharing, taking up the development role to try and push that return from whatever it is, around 5% plus or minus percentage points up into the higher single digits. So it's a very conscious move. The last thing I would say just about scale, these companies are absolutely huge. And so I did a calculation recently where 1 gigawatt of offshore wind capacity in terms of energy produced probably equates to about 5,000 barrels a day, give or take. These guys produce several million barrels a day. And so the amount of energy infrastructure, the amount of invested capital, the amount of almost everything that's in the legacy business, no matter how fast they build up their renewable energy businesses, the scales are still very, very, very heavily shifted in one direction. And the last thing perhaps to say is there's still investor skepticism around big oil doing M&A. The track record is checkered at best in terms of actual value creation from writing a big check. So there'll always be that point in the back of people's minds. Do we want people, the CEO of Shell, to go out and spend $15 billion or something like that?
Yeah, no, that's interesting. So good point. Actually, the other thing which they're not altogether embracing is project finance. Previously, they've had to on occasion when there are partners involved. So I don't know whether Jing and maybe Bert as well, you have a view of how easy it's going to be for them to get their head around project finance and the benefit that may bring them in terms of spreading their capital more widely.
Well, I mean, the only way to go into renewables is probably project finance. Can you hear me? Yeah. So because otherwise the returns are going to be extremely low. Even for the banks, renewable energy with very, very large leverage is very tiny in return. And so if these oil majors want to play in the renewable space, they have to leverage, and they have to do it with project finance. Otherwise, their balance sheets is going to balloon. I would imagine. Yeah. So that's my personal view, and I think therefore I agree with the previous panelists. It's like, yeah, they of course are going with the shareholder or NGO type of pressure, but you have to keep doing what you're good at. Yeah, it's a bit like a gold company that starts doing wind. Also doesn't make sense, because you want wind companies to do wind and you want gold companies to do gold. Yeah, so it's a question of like, okay, is there still livelihood in their fossil fuel process? Yeah, and if it is, then they should, I think, focus to a large extent on that and let other people do the other stuff. Yeah, everybody should do what they're good at. And as a bank, we will support both as long as it makes a business case, as I told you before. And if they don't want to leverage, then of course we'll be interested to help them finance, but then it will be very difficult for them to basically make successful bids. So that's a bit this. I think oil and gas companies have been active in wind, renewables, biomass, all kinds of stuff in the past. And they climb up their investments and they go down again with their investments. So it has to make sense, yeah. And then they should do it. And if it doesn't make sense, they shouldn't spend too much money on it. So, but we're indifferent. We will support what they will do, and actually not totally indifferent if they go more into renewable. We like it.
Okay, no, that's fair. And I mean, one of the other things that I think the oil and gas companies can bring, I'd be interested in your views around the new technologies we're seeing when you're looking at things like floating wind, where you're using essentially oil and gas technology, albeit it needs to be a lot cheaper than in the oil and gas industry, or hydrogen, which the oil and gas company is already producing, or carbon capture, which is a process plant where they ought to be able to run.
Yeah.
Is that going to make it easier to finance those projects if there are oil majors involved in those projects?
Yeah, I think, I mean, as soon as you start putting something underground, you want an expert to be with you. So I think especially when we are doing anything with an oil and gas field, we really would like to have an oil and gas company involved, because especially in the beginning, the risks are not totally clear. I have no idea how CO2 and hydrogen are actually going to fit in a gas field. Well, more with CO2, but less with hydrogen. Yeah, so in a salt cavern, I think it all works. In a gas field, hydrogen, yeah, it's much smaller, so it can go through pores that normal hydrocarbons can't go through. Yeah, I'd like to have an oil and gas company to look at that, yeah, if possible.
Yeah, no, I think we'd probably share that view. Just on the structure of the industry, if you look forward, and this is a question, I guess, for a number of people, maybe Tarek as well, could you see a situation where oil and gas separate? I know it's difficult sometimes to separate them as a product when you're producing it, but could you see the financing of oil being less favored than the financing of gas? So that you know, capital gets diverted towards gas, leaves the oil and gas companies to finance their oil in another way. I mean, you mentioned peak oil. I guess that's part of that story. You know, how much oil do you need after peak oil? What reserves are going to be exploitable, and so forth.
Question to me?
I don't know whether Tarek, you had a view on that from an equity perspective.
It's an interesting one. I've not had that before. I've had you know, questions about whether oil companies would build up their renewable or low technology businesses to then spin them off, and we've had that in some of the value chain companies where an oilfield services company has spun off a CCS business within it to be its own standalone basis. But separating out oil from gas, I'm not sure on that one. I mean, I know there is a you know, with access to capital, there is a ranking system of sorts, and as Bert sort of said, the coal's at the wrong end of that side of things. There's a scale, and gas is certainly one of the main engines for these companies to take things forward. But you know, gas is not without its own controversies, I would say, as well. I mean, especially when gas infrastructure, especially with the transportation side of things, can be very long-lived. You build an LNG terminal, you're making a 30-40 year investment. If you are building a pipeline, you're making a very fixed and rigid investment. And so, you know, we heard about stranded assets earlier. That does not necessarily just apply to the actual resource base, but can be the associated infrastructure. So I think personally, I think it'd be quite difficult to separate oil from gas within these companies. They all produce them at varying mixes, and they have various degrees of sort of vertical integration. But it's not. Yeah, I think it would be a bit too challenging to separate them out. The more questions we get is whether one of the big oil majors will get a foothold in a low carbon technology or business sufficient enough to stand its own 2 feet, sort of unlock value by spinning it off and being its own pure play story, and letting the legacy business go into managed decline. But like I said earlier, the way things are scaled now, that's quite a while away.
Yeah, I mean, related to that, I guess, is a question around hydrogen. Coming back to hydrogen, and you know, you often hear people talking about, in the long term, hydrogen being the LNG of the future. I don't know what the view is on that amongst the panel. Certainly at the moment, the biggest challenge seems to be breaking the sort of cycle of not enough production to create a market and not enough market to create a supply. You know, how do we get from there to something approaching an LNG type commoditized market, or is it possible even?
Well, let's not forget that hydrogen itself already is a, what is it, 70-something million ton business. So it's there. It's an established market, yeah, and you can grow from there. But if you can exchange the gray hydrogen for blue or green hydrogen, you have quite some offtake already to kind of establish your business. So I think there is offtake, yeah. It's just that it's very expensive stuff at the moment to create green hydrogen, and even blue is quite expensive if the incentives are not the right direction. So it's really a question like getting these costs down, or subsidies up, or penalties up. I don't particularly care, or whatever you want to call it, to get this going. And I think the incentives in the EU are very strong to make this happen. I think in MENA, there's lots of opportunities to produce the green hydrogen or blue hydrogen, for that matter, very cheaply. And then it's only a question of transporting it, which is a challenge on its own.
Only a question of, yeah, that's a major challenge. Maybe just bringing Jing in from SMBC. I don't know whether you have a view on how easy it is or difficult it is to finance transition in other sectors. So I'm thinking of things like mining, the metals industry, you know, some of the heavy energy intensive industries, which, you know, we've seen attempts to decarbonize carbon capture and storage with potentially hydrogen. How easy do you think it is to finance those sort of long-term investments in that industrial sector?
Yeah, I think when we look into other sectors, because we have been active in various sectors, probably similar to all the panels sitting here, while looking into various different sectors in addition to power, renewable, oil and gas. You've also got mining metals and infrastructure, etc. But I think for this whole energy transition process, I think the banks tend to probably consider from several different perspectives. One is this policy design, how we develop the bank's strategic focus to support this energy transition by bringing together the cross-sector product and department initiative and efforts to support this cross-sector approach. If you talk about, for example, mining metals, when you look into any specific minerals, the cobalt or copper, probably it's not much different from the way you looked into nickel, silver, gold, and you need to do all your technical due diligence, etc. But I think the bank's policy design and the risk framework, etc., may, when they develop more address to the energy transition angle, they probably give a better emphasis and support to those minerals which are more critically required during this energy transition process. Ideally, I'm sure a lot of banks considering, but may not be materialized. Like, for example, if you look into copper, nickel, these would be heavily demanded during this whole energy transition process, like a copper required for all these cables and various plants and electronic works, and for the turbines, etc. And cobalt, if you want to do the energy storage, battery storage, cobalt, nickel, they are important until you find some new minerals which can be put together for the battery storage. I think the other side of policy design, I think, is how the banks monitoring the ongoing environmental, social, governance performance for different projects, not only just for this it's a new project, but also for existing, for example, the gas-fired power plants and the other power plants or desalination plants. What's your carbon dioxide emission levels, whether that's in line with your ESG standard, etc. I think all these framework and the criteria will help to be set up to classify the financing products as whether they are ESG compliant or sustainable financing compliant. I think that's helped to analyze the overall portfolio, allocate the portfolio. So that's linking up to the next component within banks, is that financing resources allocation. They use this analysis or weighting, and by, for example, certain mechanism being set up to decide how the resource being allocated to more ESG compliant sectors, etc. But ideally, the regulator can also help a role by allowing the banks to release more risk-weighted assets, if more financing by committed onto the ESG compliant project, etc. I think that's the other way to support the banks to release more capital and support the sector and support development of energy transition. I think finally, in addition to the policy design, financial resource allocation, the other aspect is about the human resource commitment. Because we have seen this energy transition, it's not just like a one sector story. It's not just a power, renewable, not just the oil and gas. I think you will require the cross-sector expertise. Just to take the electrical vehicle as example, naturally you will have the transport side, the expertise, but also when you look into how the petrol station may be changed to those charging stations, you will have the infrastructure side and how the charging stations will be linking up to your national transmission and distribution network of electricity. Then you will also get engaged the power renewable side, as well as how the power or renewable power will be generated to be transmitted and renewed and distributed here. And meanwhile, for these EVs, you need one of the key components is this battery. Then you have to engage this mining metal side about how the mineral supply chain be managed, etc. So I think this from this policy design, financial resource allocation, combined with cross-sector expertise be putting together. I think that's how the banks will help this clients from different sectors in this whole energy transition process.
Yeah, no, I think that's one of the interesting sort of areas for us is the crossover between all the different sectors. I think many of the banks are now looking at energy more holistically, including infrastructure and energy projects related to infrastructure. So it's an interesting angle on it. Maybe for Ting, I think Tarek mentioned green fever, and one of the potential outcomes of a very rapid transition and people hunting assets is that we end up with a bubble in the renewable energy, particularly in the financing side, because often the companies are looking to leverage as much as possible, cheaply as possible, to get an advantage. Do you see that as a significant risk now for the finance sector?
I think there is an element of that, but I think it's really sort of more project by project basis. I think in projects and in countries where there's stable subsidy regime and you have long-term good subsidies with good price guarantees, I think the risks are relatively limited or capped. Whereas I think there are certain geographies where there are subsidies, but the regime's either not so stable or where there are sort of say pitfalls. And I think there's definitely a risk. I think the renewables industry has sort of evolved quite a bit now. That I think some of the earlier evolutionary risk have been taken out. But I think there is a sense that there are a lot of people chasing a lot of money chasing very few good projects at the moment. And I think this is sort of this comes back to ultimately will the next few years be the same as sort of what we've seen in the past when we start to see more unsubsidized projects and you have greater scale of adoption and build out, because I think that's when the true test will come. I think if for the sort of the newer unsubsidized projects, there is the same level of competitiveness, you can see that inherently there's going to be a lot of risks. And I think the other point to make is that up until now, we've had the benefit of a sort of an increasingly favorable financing market, especially for projects with subsidies behind them. I think there's a question maybe to the other panelists really, and how much lower can financing costs go, and how is there going to be enough capital from banks going forward to support the bigger quantum of projects coming to market?
I think particularly, as you say, when there's an increasing element of merchant risk in those projects, I don't know what the bank's view or the different banks' views are on merchant risk, but there doesn't seem a lot of appetite at the moment to take merchant risk in the offshore wind space, for example, or not a significant amount.
I think we have seen, for example, recently the Sea Green offshore wind project being closed, which has a partial exposure to the unsubsidized regime there. We also see before pandemic, actually some banks testing the market with some smaller exposure merchant. But one thing I think the devil in the detail is that, yes, some projects may not have a subsidy, but they have the other components to provide as a risk mitigants. You either have very strong corporate PPA counterparties within investment grade, which literally you transfer the policy and political risk under subsidy regime to a counterparty credit risk. Because even subsidy, to be honest, that's not risk-free, because there might be change of policy, like what happened in the past in some countries. You change the subsidy regime retroactively, then that's changed the investor confidence completely. That's one part. I think the other side, you also see some ECAs getting involved to provide cover to support their exports, but on the other side, help to cover the bank's exposure under certain merchant revenue there as well. And meanwhile, I think the return always associated with the risk here, or price always associated with the risk here. When you talk about the merchant, then I think the debt sizing parameters and DSCR ratios, etc., that would be all different when you compare with the project with the merchant exposure and those with a subsidy or I think cash flow certainty projects.
So is that a role potentially for the oil and gas companies if they're moving into electricity, as Shell and many others are, and they're going to be trading electricity? Is there a role for them to be the off-taker of these projects? The high quality credit, if you like, taking the offtake.
Yeah, that would be nice. That would be good. And quite clearly, that is a role that they're quite keen to take. If you look at how well they're doing in oil and gas trading, then quite clearly they have some opportunity there in the energy trading, electricity trading as well. And we assume that that's one of the niches where they feel they can make a contribution and have the expertise to trade, and therefore take certain risks that others are not willing to take, and therefore take a nice cut of the whole thing. So we do foresee that, but I want to kind of like reemphasize that banks, of course, will get much more conservative if they're to take market risk. Yeah, so ratios go up, debt to equity gets more conservative, etc., etc. So it's all a question of risk allocation, and given the fact that banks have very limited capital, or basically have to allocate capital for more risks, they then need to charge higher margins, which is currently not in the book. So it's kind of quite dynamic, and there will always be cases where maybe one or two banks take a different view, but as a whole, the banks will reflect the market risk in their models.
Yeah, I think when we're talking about, as we are now, 2 gigawatt projects, increasingly large projects, I think it's a bank market view which is really carrying the day, rather than the more innovative banks who might be prepared to take a bit more risk. You know, we're talking sort of $4 or $5 billion financings now, not in offshore wind particularly.
Yeah.
I think we're coming towards the end of the hour, so maybe one question for everybody, just to close things out. I mean, if you're assuming you still are lending and advising in 2050, how do you see the industry then? You know, what are the projects you think you're going to be advising on? Did we get to net zero? You know, is there still oil in the mix, and what do these companies look like? Bit of crystal ball gazing, I guess.
My first question would be where. Yeah, I think certain countries will get there. At the moment, China has, what is it, 26% of CO2 of the world it's emitting, and they have a target of 2060. Yeah, so I think if China is not there, it's going to be incredibly difficult to get to net zero. So quite clearly, yeah, with China, then we can get there. Without China, we may be able to get there in certain regions on a net basis. Yeah, I think net is the key to the whole discussion, because there will always be some emissions at some level. And if you look at what we just showed you till 2040, we do anticipate that there will still be, certainly will be gas around, be it carbon captured or not.
Tarek,
I'll give a couple of quick thoughts. Yeah, 2050 is a long way away. I mean, I think things will look very different. Obviously, there will still be oil and gas in the energy system. It's I think that's too great a feat to achieve in 30 years. But achieving net zero is, I've looked at all the numbers, the emissions, and the charts and the bending curves. It's a real feat. So I think it's going to be extremely sort of challenging to get there. But I think the increased conviction around the world will be will give everything a bit of a push. In terms of what kinds of projects, I think a lot of what we know now will be there. You know, a lot more CCS, things like hydrogen, grid balancing, and working out how to harness the intermittent new powers will be something interesting. The only thing I'd say as well is, with some of the low carbon technologies, there won't be a complete slam dunk. Once they scale up to certain points, you might run into other issues. You know, hydrogen is a thirsty energy source, needs a lot of water. There's land use concerns around solar. So I don't think, as and when we get through this transition to the next phase, it'll be the end point. It'll be a continuing continually evolving topic for many, many decades to come, well beyond our time, I think.
Yeah, I tend to agree with that.
Yeah, I'm bullish on reaching net zero by 2050. Maybe not for China, but I think if you look at the targets, we're seeing targets being brought forward in most countries in the developed world. So I think that trend, it will be very difficult to break that momentum. I think Tarek makes a good point. The grid parity and stability in the grid and storage will be very important as well. I think there shouldn't be sort of the volatility in the power prices that there is today. And if you look at the rate of adoption of technology from software to sort of better grids and technology and hardware in general, I think that will help the market. And I think in some ways that will also help the acceleration of the adoption of renewables, which are obviously, right now a lot of investment models are capturing downside to the sort of with capture discounts and cannibalization. So I'm quite bullish that we have the momentum, certainly in the developed world, to get there by 2050.
It's an optimistic view.
Yeah, I think I share the optimism here. I think by 2050 we'll be able to achieve it, and I think but for 30 years, what kind of project we will finance or look into it, I think it's too far away to predict. Just look back what happened during the past 10 or 15 years, just like in offshore wind sector. 10, 15 years, people were looking into a wind turbine like 3 or 4 megawatts. Now we talk about like 14, 15 megawatts. It's just like a decade. And I think if we talk about 30 years ago, we probably barely know that one day the renewable energy can literally contribute to all the power supply for our country. But this summer we did have it in the UK. And I think they achieved much earlier than we probably expected. And meanwhile, back in 1990, it was probably hard to imagine using iPhones and you play your games on your iPhone and just using all the software on your just a small phone. So I think I wouldn't probably try to forecast or predict what kind of the projects and technology would be available. I think they'll be pretty evolving quite quickly, but I'm confident we'll be able to achieve net zero. But one thing critical is that this requires all the stakeholders to work together. From the government side, they need to put in the right policy to support and jumpstart, and especially for this new technology, like what they did for the offshore wind, like what happened in the UK. And you need to make sure this regulation and policy consistent and stable to attract and keep the investors' confidence. And also, hopefully, the new financial products being developed, as well as the market being developed with less and less reliance on the government supporting schemes. I think if we have all these in place, I think net zero could be achieved.
Yeah, I tend to agree as well. I'm quite optimistic about it. I think that's probably a good place to end it on an optimistic note. So I want to thank Tarek, Bert, Ting, and Jing for an interesting discussion. And I'm sure we could talk for hours and hours about transition, what it looks like. But if there are any questions, more than happy to answer those or follow up with emails afterwards through the organizer. So many thanks for your attention.
Thank you.
Thank you.
Thank you very much for your time and your information today shared with all of us. We have around 200-300 people listening, but I don't see any questions as of now. If there are any questions, I will pass it on to you respectively.
Great, many thanks.
Thank you, everyone. And
thank you for sharing, Allan.